Let's be honest. When you hear Wall Street, you probably think of glass skyscrapers, high-frequency trading, and jargon designed to keep you out. And when you hear Main Street, you think of hard work, local businesses, and the actual economy we live in every day. For too long, there's been a massive gap between those two worlds. Welcome to the Main Street Meets Wall Street podcast. I'm Marcus, coming to you from Wall Street South. We launched this podcast and built this show on a very simple premise. I help Main Street meet Wall Street. We aren't here for get-rich-quick schemes. We're here to translate global market trends into local reality. We're covering the entire economy, from the Federal Reserve's latest moves to the heartbeat of the corner store. But I'm not doing this alone. We're bringing on the heavy hitters, industry experts and financial veterans who just aren't here to talk. They're there to break down the complex Wall Street jargon into Main Street English. And on the days when the news is moving fast or the topic needs a deep dive, I'll be going solo, stripping away the noise to give you a direct, no-nonsense look at exactly how the headlines impact your bottom line. We're living in a time of incredible change. The old rules are being rewritten, and the lines between the trading floor and the storefront is thinner than ever. We launched just a few days ago. Not too long, because this conversation needs to happen. You don't need a blazer and mahogany desk to build wealth and understand the world. You just need the right perspective and a seat at the table. So we built the table. If you know, you know. It's time to bridge the gap. Join me as I help Main Street meet Wall Street. Don't miss a single episode as we build this community from the ground up. Hit that follow button and subscribe to the Main Street Meets Wall Street podcast right now. Anywhere you get podcasts. Main Street Heart, Wall Street Smarts. Let's get to work.
In February 2026, the tech world faced its Lehman Brothers moment. We saw the SaaS apocalypse, a 48-hour window where hundreds of billions in software value vanished. As the market realized that the old per-seat model was being automated out of the system, but to truly understand why this happened, you have to look past the stock tickers and into the cold math of the ledger. I'm sitting down with David Snyder, of CIO of Journey One Advisors. David, welcome. Let's get straight to it. You lived through 1999 and 2008. Looking at the circular flow of capital today, where big tech is essentially funding its own AI revenue, is the SaaS apocalypse we just saw in February the final warning sign, or is it just the first domino in a much larger systematic collapse?
Well, I really think the market is way overdone how much old tech is going to be affected by AI. So the similarities are so strong with the late 1990s with the internet. Back then we had almost every industry was going to be disrupted and made obsolete by the internet, whether it was real estate, distribution, financial, all the financial firms are going to lose out to internet trading. And so they really depressed the valuations dramatically. Like in drug distributors, there was no need for a distributor. And you had this incredible increase in valuations of the internet, while at the same time, lowering of valuations in all the industries that people perceived was going to be affected negatively. So today you have the same exact thing in obviously, software as a service is the number one industry that's being affected, and the valuations have declined by 60 to 70% over the last year. However, my belief is that it's way overdone, just as the internet was overdone. Back in the late 1990s, a lot of those industries that people thought were going to be disrupted actually ended up surviving and doing very well. And the returns from March of 2000 for the next 10 to 15 years actually were very strong for a lot of those groups. For instance, the Real Estate Investment Trust, they were one of the best performing groups from March of 2000 in 2015. So today you have the same thing. So there's just too much enthusiasm for AI and how much it's going to disrupt, and how they don't believe these industries are going to be able to adjust to the new to AI and adapt it in their models. So we're seeing a very similar dynamics playing out. It's somewhat eerie that it's so similar to what happened in the late 90s, which would mean eventually that AI bubble will burst, and then all of the industries like software will actually increase in value as they go down, when people realize that they will benefit from AI.
Whoa. Yeah. So back to the 90s to 2026. And the big thing, I think you said a lot of interesting things in here, but the big thing was the last thing that you see, the AI bubble bursting. That's very interesting. I mean, you're definitely on the other side of the fence with that one compared to most people, I think. You care to go a little bit deeper into why you see this particular bubble busting? I know most people say that history may rhyme, but it's not the same.
Well, every generation has a new revolutionary technology. Every secular bull market had a new revolutionary technology. We had the railroads in the 1800s, and then in 1893, Pennsylvania Railroad, Reading Railroad went bankrupt. They overexpanded. You had in the 1920s, car ownership went from 20 to 60%. The automobile changed the world. However, they overexpanded, and we had the Depression. And of course, in the late 1960s, we had the first technology rally, and it was because of Moore's Law, and where integrated circuits were first mass produced. And it was an amazing new revolution, miniaturization of computers. And that all came to a bust in 69. And then, of course, you had the internet in the late 90s, which is a new revolutionary technology. So this is nothing new. This has been repeated time over time. It doesn't matter how good the technology is. It's the human response to a new technology. So there's three factors. The first factor is the companies that are developing the technology and using it become overenthusiastic, and so they invest more capital than they should in the short term. Their second mistake is it's called FOMO, fear of missing out. So they'll invest more than they should because they don't want to be left behind. And those are two on the corporate side that cause overexpansion. So we've had every one of the major hyperscalers say they are going to err on the side of overspending. So they're basically telling you they're going to overspend. So you have that, and then you have on the investor side, the investors have an insatiable demand for this new technology, and then they overvalue all of these companies. And so again, it doesn't matter what the technology is. It's those three factors I just mentioned, the human response to those technologies. In fact, I would argue the better the technology is, the more likely the bubble is going to burst. And what we know also is that the bubbles burst in the first 5 or 6 years of a new technology. And so everybody is saying that AI is just in the first or second inning, just like they said the internet was in the first or second inning in 99, 2000. But they're right. It is the first or second inning, but a bubble burst, and then the internet grew when the bubble burst in 2000, internet still grew dramatically for the next 20 years. So it's just this interim period where people become overenthusiastic and overinvest. Investors also, overvalue, and then the whole thing burst when just one little thing goes wrong to end that kind of perfect scenario.
Okay. So those are definitely interesting takes, contrarian takes for the most part, like I said. I think some people would say maybe on the other side of that. So, even as I'm posing this question, I'm kind of thinking this myself, because so we have these companies now. Some of these are the greatest companies in the history of the world, correct? Modern technology, you can kind of say that maybe. But I guess with all these other revolutions were happening, those companies were also like the greatest companies in the world at the time. My question is and I'm sorry to dig so deep into the AI bubble, but that's a big thing. My question is, how do you see the companies leading the way now? So you have the Metas and Google, companies like that spending a lot of money on this CapEx compared to who was leading back then, Cisco, IBM, which ironically this old tech has come back into play. How do you see the leaders now compared to the 99, 2000?
Well, I think they're very similar. All of the hyperscalers that are leading this basically have negative cash flow. They're spending every dollar of their operating earnings on CapEx. So there is a big discrepancy now between earnings and cash flow. And we haven't had that discrepancy since the late 1990s, when there was also this huge increase in capital investment for the internet to, broadband, all of that. So it's very similar. the market, and by the way, these cash flows are not going to increase much for the next couple of years. So you have to, if you really believe in these AI hyperscaler names, you have to believe in 3, 4, 5 years they're going to get a return on their capital, because they're not going to get it in the next couple of years. I mean, they even, the projections. In other words, they're still in the CapEx investment cycle for this. So it's very similar in the sense that they are spending enormous amounts of CapEx for this new technology. If it continues, they're going to end up. The similarities are they're going to end up that they're going to realize they spent too much money on all of this, and then of course their earnings and cash flow will go down even more because they won't get a return on investment that you're hoping for, at least not in the near term. But then what's very interesting, what happened in the internet is broadband prices dropped like 95% during the bubble burst. And that actually, ironically, increased the demand for broadband because the prices came down. So you could have the same scenario this time where all this money spent on data centers, on AI, all drop dramatically in value. And that actually will stimulate the second kind of expansion, and even better expansion, because you're going to be doing it at very low prices. So, we have that. We have the competition with China. China is way more efficient on a dollar, per unit basis for AI, literally 10 times more efficient in spending money on the internet. On AI. They're getting similar results for spending 30, 40, $50 billion, and we're spending like 700 billion. And they're getting similar results. So it's what could happen is all the capital could chase, the capital invested could move towards more efficient models. And so that's another possibility how it could burst. It could burst because the data centers, it's very hard to get approval. It's, not in your backyard, not in your backyard development. And there's all kinds of issues over water, over chemicals, over increased utility bills. The state of Maine just outlawed any new data centers, although the governor is going to overturn it. So, if you don't have enough data centers, it doesn't matter if you have a lot of demand, you're not going to be able to fulfill it. So there's all kinds of things that are possibly going to go wrong. There is just an IPO of a nuclear module nuclear power company that won't have anything up and running till like 2032. The valuation was just enormous earlier in the week. So the market is investing in something 6 years from now, when they will just finally have an operating system, which is just crazy. And who knows if, the politics change, Democrats are not in favor of nuclear power. If Trump loses in 28.
Let's pull up right there and take a breath. David just laid down some heavy history. When he points out the greatest technological bubbles in history, from the railroads in 1893 to the internet in 1999, all burst during the first 5 to 6 years because of human fear of missing out, you need to pay attention. Wall Street is telling you that AI is a permanent money machine. The cold math of the ledger says hyperscalers are burning every dollar of operating earnings on CapEx right now. We're only 10 minutes into this, and the institutional fog is already clearing. If you're catching this on your phone right now, or you're watching it on your mobile, do yourself a favor. Hit the thumbs up button. It tells the algorithm that Main Street wants the truth, not the corporate hype. If you're listening on your ride, when you get a chance, give it a 5-star review. Let's head back to the table. David is about to expose how some of the massive valuation discrepancies playing out right now look exactly like the months leading up to the 1999 crash. Let's look at the tape.
Democrats could come in and put all kinds of regulations back on nuclear, and they've been never ever come close to meeting their. So we have all of these crazy scenarios happening, just like it happened in 99, 2000. And the other thing, Marcus, is one of the most, every cycle this happens. In 2007, before the financial crisis, Blackstone, the biggest leveraged financial, private equity company, went public 2 or 3 months before the financial crisis, sucked everybody in, and then the whole thing fell apart. You had Coinbase went public in April, May 2021, right at the top of the Bitcoin, the crypto bubble. You had in 99, you had 2000, you had Priceline, and all the biggest IPOs came in 99, right before the internet bubble. So what I'm waiting for is we now have SpaceX, Anthropic, and ChatGPT, all $1 trillion or more valuations are going to go public in the third and fourth quarter. And so I don't think the AI bubble is going to burst until they go public, because that will suck in all of the money into those three companies. And then the market will go down afterwards, just as every other cycle. That's the way it happens. So, that will be the top when all of those go public within a few months after, most likely. Historically, that's the way it's worked. When you go bring the biggest players public right at the end of a favored industry.
Wow. Yeah, those are some eye-opening facts right there. Some ways to go back and just analog with the past, and it definitely is similar as far as it goes. I would say so with the hyperscalers, and I argue. And I'll tell people this, like Apple's one of the best companies ever, right? Apple doesn't spend a lot of money. They haven't spent a lot of money in this AI build out. And Apple's going to be, in my opinion, and don't take this as investment advice, anyone listening for like a specific stock, but I think Apple looks like they're going to be the one that will come out on top just based on their already user base that they have. They haven't spent a lot of money on CapEx inside of AI. So, and another thing is I do think that with the AI, some of these big companies, like some of these huge companies that we hear right now, they're going to go away. Like they'll never be here again. And people are going to be amazed by this fact.
Well, you're right, because Google didn't go public until after the internet bubble burst. So some of those dominant companies occurred after the bubble burst. So we don't know who that's going to be. As for Apple, is just licensing the technology. That's great, but in the short term, but in the long term, you never make as much money licensing something as you do actually making it. So that's the negative, and they won't control their destiny with it because they're always going to be licensing from somebody else. So I think in the short term, it's good for Apple. In the long term, they're not making these investments. It's going to, and then of course with Apple, that we that with the glasses, we may not have, the phone might not be the center of our universe in 10, 15 years. So they have that risk. But as far as the AI, it is, in the near term, they will do better on a relative basis. So I agree with you there.
Yeah.
But,
and Apple also has all those services built in. I know my Apple Music payment comes out every month. You have also, but so thinking about in the same vein, thinking about Apple and their multiple sources of income, which may be a reason why AI wouldn't sink this company. Google, Alphabet, right? They have a lot of things, different ways to incorporate money. They have YouTube, they have Waymo, which they haven't even put on the books yet, which I guess will have to play into the AI if that's going to be some type of driverless technology. And then even Meta with the Facebook, but they're spending a lot of money as far as hyperscaling go. Does the way that these companies are funding this, like Apple, it's a small percentage and they have a lot of other ways of making money. Google is a larger percentage. They still have a lot of ways of making money. But then you go to someone like Oracle, Oracle has, not a whole lot of ways of making money. They were based on the SaaS model somewhat, even though they're into the data centers and they're into the software. So it's a layered question. Dig into it.
So first, the SaaS model, it's going to change to a value-added model. So there may be just some disruption in the near term, but these companies are going to learn to just sell their services as on a value-added basis instead of on a seat basis.
Can you expand on what that means?
Well, basically, these software service, when they sell seats, they add each unit, each person, a new employee is going to get a new seat, is going to be using all the products. So they're basically tied to how many people they add to their user base. And so with that being disrupted, they're now going to just do it, change to a model where they'll just charge companies how much they use on a value-added basis. So what should happen is they should see more revenue per person using it, even if they're not, you're not using, getting additional seats. So the whole model will change. Getting back to all those companies, all those other companies have divisions that will, they're not going to get in financial trouble because they do have the security of these other divisions to provide cash flow. The only thing I would tell you, though, is that the companies just mentioned are heavily dependent on advertising revenue. Especially Meta and Google with YouTube, and that is a highly cyclical industry. If you look in 2022, we didn't even have a recession, and all of those companies had big earnings declines. So if we go into a recession, there will be they won't have as much support because they're going to lose, just like in 22, it'll be even worse. They'll have much lower earnings because the advertising revenues will shrink in those other divisions. So then they'll even have less support for CapEx. So yeah, that could be an issue for them down the road.
Gotcha. Yeah. And so I'm glad you elaborated on, because I think from the conversation that we had so far, people may have gleaned that you were mentioning that like these companies will go belly up, all of them, just if the AI bubble bursts, which we're going to get into if this AI bubble bursts. Let's talk a second before we get into like what it will look like if this bubble bursts. How about you give people some signs that they should be looking for to see if this bubble is about to burst? What are you seeing that makes you just said a few months, a couple minutes ago. So what's giving you that time frame for a burst?
I mean, I think it's going to happen within the next 12 to 18 months. So one of the biggest signals is these major companies going public. Anthropic, ChatGPT, SpaceX, although it's not directly AI. That's a big warning sign. You have what could happen is, as I said, there's a lot of things that could go wrong. You're definitely going to get a deceleration. I mean, they've been growing CapEx by 50, 100% the last couple of years. It's definitely, even in the projections for 27 and 28, they're definitely going to slow down, although they'll probably raise those numbers. So there will be a slowdown. But there may be a point, you're going to look for, some kind of news where they're not getting. I don't think this is it, but the reports yesterday in the media about ChatGPT not meeting their goals on revenue. So if you get more of that kind of, commentary, that could be the tip of the iceberg to start. And it's all a vicious cycle. Once it's going to hit all the way back to suppliers to.
We're officially about 20 minutes deep, and this is where your strategy gets a little sharper. David just dropped the massive warning signs that he sees. He expects the AI bubble to burst within the next 12 to 18 months. Analyzed by mega IPOs like SpaceX and ChatGPT, sucking the remaining capital out of the system. To the 46% of our audience watching this on a computer with your spreadsheet open, I hope you're tracking these timelines and metrics. This isn't about panicking and dumping your assets. It's about building an airtight, leak-proof roster before the supply chain takes a hit. If you're realizing right now that your current financial strategy is relying on index funds and prayers, you need to lock in. We just crossed the 100 subscriber over on Marcus's YouTube channel. Thanks for everyone who's joined. If you haven't subscribed yet, hit that button right now so you never miss these great conversations. Let's get back to the footage. David's about to break down a factor nobody's really thinking about, and how demographic shifts and a lack of the labor force are putting a massive hidden strain on our economy. Watch this.
To the data centers, to the industrial companies that provide the electrification for the data centers. So everybody's tied into this cycle on AI. So they're all going to, if one gets hit at the top, everybody else is going to get hit, or all the way through the supply chain. So it can just be a vicious cycle on the way down. There could be all kinds of things. There could be, the chips aren't, become so efficient, you don't need as much data center power, or just, all kinds of things like that could happen. But the biggest thing will be, in my opinion, they won't get the return on investment, and then they'll have to slow down their CapEx. I think that's going to be the biggest issue. Institutions are slow to change. As good as this new AI technology is, it's hard. You're talking about having, these systems ingrained in these corporations. To tear them out, it doesn't happen as quickly as people would hope for when something like this happens. People are slow to adopt these new technologies. So I think that's going to be an issue nobody's really thought about, that it will take more time. Even if the technology is that good, it'll take time to adopt. So it's just going to be a slower, pace. I mean, I heard yesterday somebody on CNBC say that they hope that it does slow down because that way it won't be, get out of hand. And I'm thinking, no. If there's any evidence of a slowdown, all the stocks are going to get hit really hard. It may be good for the long run, and then it would be a massive sell-off if they all started to slow down their spending in the short term. We're at a point of no return. I mean, if they start slowing down now, it's going to be a disaster. If they keep spending even more, you're causing even more of a bubble. So they're in a catch-22 at this point, the hyperscalers. So yeah, so I think it's a very dangerous. So there are so many. You usually need a catalyst to get the market to go down, especially these hyperscalers and all the AI. So you need some kind of we have these oil prices staying really high. These are real companies, Marcus. So people think, oh, they're just going to adopt AI no matter what. Well, let me tell you, if oil prices stay high and we enter recession or just whatever slowdown, these companies have to cut spending. And people think they're not going to cut AI spending. No, they will cut AI spending, or they won't grow as AI spending as much as they were hoping to. So yeah, the overall economy can affect the AI spending. So, but oil prices today, just what did I see, rose $5 to like 104? I mean, it's 7 weeks into this. So that could be the catalyst down the road if that continues. So yeah, we have every measure we're extremely overvalued in the stock market. So, when you get to this level, it doesn't take much. You're very vulnerable to any kind of bad news because you're at such high valuations. And by the way, Mark, it's not just valuations. Everybody's saying the tech valuations are lower today than they were in the late 90s, which is true. It's really earnings. So earnings caused the collapse of the internet bubble more than the valuation. So you could easily get a 50% drop in tech earnings in a bubble burst. So right away, if you have a 50% burst 50% drop in tech earnings, and you remember the big bulk of tech earnings now with semiconductors doing so well. So you could see, if you have a 50% drop in earnings, you could easily see a 50% drop in the stock market, right? Because if you just stay at the same valuation level. So I'm not convinced just because the techs, and then you have the other industries like industrials, which support the AI. The industrials are trading at all-time high valuations. So it's not just tech that's causing the PE to be at 21. So you have a lot of other industries that are somehow attached to the AI revolution that would also come down dramatically. Marcus, this is so similar to the late 90s. It's almost too easy. Too easy that the bubble will burst in the next 12 to 18 months. I mean, we've had 17 years of real returns in the S&P 500 of about 15%. That's exactly, almost to the day, it's very within months of the 1949 to 66 bull market and the 1982 to 2000. Both of those are about 17 years and about 15 to 16% real returns. Real returns are 6.5% a year over the last 100 years. You don't have to be a math genius to know. If you get 17 years of 15% real returns, and you average 6.5, the next 10 to 15 have to be like negative real returns, which is what happened between 2000 and 2009 when we had negative 3 or 4% a year returns, or 3% a year returns. We are, we're
almost half an hour in and David is pulling no punches. He identified that we're living through one of the most dramatic K-shaped economies in the U.S. history, where corporate profits are being sustained purely by sacrificing labor. Is this the exact formula for chaos that we've been warned about? When the next market downturn hits, the wealth effect means the markets will stay down longer and hit the real economy harder than ever before. To all the people watching right now, this is why financial literacy isn't a luxury. It's your shield. You cannot out-earn a structural flaw in your ledger. We are entering the final stretch of this archive session, where we pivot directly into how the upcoming Federal Reserve regime change under Kevin Walsh is going to test these hyperscalers and impact your wallet. Stay locked in. Let's finish this out in part 1 with David Snyder.
We're following almost to a script what happened that ended the 62, the 49 to 66 and the 82 to 2000 bull markets, almost to and the other eerie thing is the biggest, at the end, it was the semiconductors. And if you notice, the semiconductors have been on fire for the last 3 weeks. Well, I went back, and in the internet from June of 96 until March of 2000, the semiconductor stocks, the index, went up 8-fold. from October, using that's 3.5 years, right? From using October of 2022 until today, which is about 3.5 years, we're up about 6.5-fold in the semiconductor industry, which is these are like the two biggest increases in semiconductors ever. But the parallel, 3.5 years, almost the exact same parabolic increases as back in the late 90s. And by the way, we had the same thing in the late 60s with semiconductors, had this enormous run, and then the bubble burst. So we have that parallel, which is just scary. And both of those bull markets, Marcus, in the last 5 years is when a new revolutionary technology came out. And back then it was the integrated circuits, the Moore's Law, and also the aerospace. So you had, now this is the same way. We had the last 5 years has been the AI, just like the last 5 years in the 90s was the internet, and the last 5 years in the 60s was integrated circuits. It's crazy how closely they parallel. Also we had right now, price to cash flow is 28 times the S&P 500. That's the highest since the late 90s. We are the biggest discrepancy between price to cash flow and price to earnings since 99, 2000. Another incredible parallel. So we have just incredible, and then of course we have the parallels of the disruptions of every other industry going down, like software. And back then it was, real estate and what we discussed before. So we have that parallel. I mean, there are so many parallels. It's crazy. It's just incredible to me.
Whew, yeah. All right. Hold on, David. Let's pull up and take a breath for a second.
Okay.
You just gave Main Street a lot. People might be calling and trying to get out of all of their AI investments right now listening to this.
Right now. I'm not saying right now. I'm saying within the next 18 months.
No, you're good. I understand what you're saying.
And by the way, Marcus, don't forget, the biggest gains occur at the very end, and the biggest losses occur at the very beginning of a bear market. So it's very difficult to time. If
possible to time almost,
Yeah.
I was going to say, just speaking back to the market, this market may be different though. I don't know. You've seen a lot of markets, maybe all markets are the same. So you talk about resilience, and you mentioned China and how much cheaper they are using AI technology. We saw DeepSeek at the end of 24, if I remember correctly. And that was really like a Lehman Brothers moment for NVIDIA, if everyone remembers. It went really far down, but then it came back. And then we've seen, let's say, I'm just trying to think, since DeepSeek, we had tariffs, which were, we saw what we did to the market. The market just moves different. And now we're in this Iran conflict. The market moves different. I don't know if it's the speed of information. I don't know if it's the retail investor. A lot of people invest in the market have never seen a recession, they've never seen the market go down. So people are sitting here listening to you speak right now, David. Go back and tell them a little bit about yourself and your history and what you've seen, so they know, pay a little bit of attention to this ghost whisperer we have on here right here.
Well, you're right. It seems different, but actually what's happened so far, Marcus, is exactly what you would have thought would happen. In other words, if I go back to March of 2009, when this secular bull market started, and if you had told me back then, Marcus, if you had told me, Dave, it's a new secular bull market, what's going to happen? And here's what I would have told you. I would have said we're going to have 17 years of about 15 to 16% real returns of a secular bull market. It's going to last 17 years. And at the last 5 or 6 years, I don't know what the technology is. We're going to get a revolutionary technology that's going to capture the imagination of investors, and it's going to cause a bubble, and the bubble is going to burst, and the secular bull market's going to end. So that's exactly what's happened so far. So nothing that has happened so far wasn't predictable based on the past two secular bull markets before this. I mean, we're perfect. It's almost a perfect now. But I will tell you is, if this lasts past next spring, then it will be different. Okay, then it will be different. But in those two, but Mark,
say that again for the listeners, David. What you just said.
If this secular bull market AI lasts past next spring, it will be different than any other secular bull market, because that would last more than 17 years, and the returns would still be, very high. But you're talking, you're talking about how the market bounced back from tariffs, from the oil spike, from the Iranian war. But in the late 90s, Marcus, we had the Asian crisis in 1998, and that was very severe. We had a depression in a lot of countries in Asia, and we had the long-term capital where they almost went under. So we people were shocked how we bounced off of that and came right back. 98. Like that was a 20% drawdown in a couple months, just like the tariff did. But we bounced back immediately. And we had in 96, we had a high yield crisis, and we had, different things happen, and the market would keep coming back. And people would say to me, Dave, this market's incredible. It just comes back. It doesn't matter. People just buy the dips all the time. Yeah, well, that happened for 17 years. And then after 17 years, guess what happened? The internet bubble burst and everything went on. So when people tell me, Dave, this market's different, it's resilient, we have everything that happens to it, whether it was the inflation spike in 22 or the, tariff, a tantrum in 25, or the oil spike to this in 26, the market just comes back. That's what happened. That's no different than what happened in the late 90s or the late 60s. So only if it continues past next spring will I be convinced that this is something different. And I don't believe it will. This one thing we haven't talked about much is productivity. Everybody thinks it's going to be the panacea, right? And it really hasn't happened yet. People keep quoting these huge productivity gains, right? However, we had negative productivity for like 4 or 5 quarters in 22 to early 23. So we have had increased productivity since then, but that's only because we have had a big, rebound from negative productivity growth in 22, early 23. So if you average that out, it's really not that great. And if you go back, I think I saw that after 20, productivity is only averaged a little over 1% a year growth after 21 and 22 until now. But everybody will quote you from mid 23 until now, and they'll say productivity growth is 2% or greater now. But that's just a function of a rebound from a decline. But here's the problem with productivity. In 2000, we had the highest productivity we ever had, 4.2%, I think it was. And the stock market went down, 15% that year. The economy went into recession the following year. My point is, it's not a panacea when it depends on the context. Productivity grew 3.2% between 2000 and 2004. That was higher than the 3% from 1995 to 99. Yet the stock market went down in real terms 4% a year from 2000 to 2004. So productivity growth was the highest ever. I mean, not the highest ever, but the highest in multi-decades from 2000 to 2004. And we had not so great economy, and we had stock market declines on average, annualized at about minus 5% on a real basis. So it's not a panacea. Even if we have a pickup and by the way, inflation went up in 2000 from 2.8 to 3.4%, even with productivity of 4.3%. So it depends where you are in the business cycle. If you're already close to full employment and inflation is starting to rise like it is now, the productivity is not going to save you. It didn't save us in 2000. I don't think it's, we have no labor force growth because of the demographics, as you know, because no immigration and because of the baby boomers retiring. We have a decline in the labor force, out there. So that means you are dependent on productivity for growth. I don't know if you know, from 1950 to 2000, the GDP grew about 3.5%. And of that 3.5%, about 40% was from aggregate hours worked. About 1.6% a year, aggregate hours grew. So you had almost 40% of GDP growth was aggregate hours. We can't grow aggregate hours now much, okay, because of the demographics. Aggregate hours are based on, how many hours the labor force increases every year. If you don't have increase in the number of people working, you're not going to grow aggregate hours. And with the demographics, it's going to be very difficult. So my point is, almost half of GDP growth came from aggregate hours work. Now, in the next 10 years, we're going to almost have no aggregate hours, so we're totally dependent on productivity. So if productivity does it needs to grow, over 2% in order to get GDP at 2%, because you're not getting you're losing that whole other growth factor. So that's something that people don't understand. So yeah, you will, even if productivity goes up a lot, it's not going to offset the loss of aggregate hours growth that was 40% of GDP growth from 1950 to 2000. So
Okay.
that's a big deal that people aren't thinking about, overall. And also within that, Marcus, even though aggregate hours grew 1.6% from 1950 to 2000, the number of hours people worked declined. But because labor force growth was so high, it was greater than 2%, aggregate hours can grow 1.6%. So if we continue this trend of people working fewer hours in the workforce per week, per year, right? That's another, if you have no labor force growth, that's really going to take a hit on aggregate hours, right? It's really going to affect it negatively. So this is a major force, and it's a big reason. I'm doing a big thing right now on how the amazing thing is that earnings, GDP grew like 2% a year last decade, but earnings grew like close to 10%. And nominal GDP, we already grew like 5%, but earnings grew like 10% a year. Well, if you go back to, last 100 years, nominal growth equals GDP. GDP usually equals earnings growth, very close. In the last 20 years, earnings growth in the S&P has been way higher than nominal GDP growth. And the only way they did that was through the labor getting less percentage of sales, right? They're taking away from labor. And now we have this K-shaped economy. You can't keep taking away the revenue, giving more revenue to the owners versus labor and capital, giving more money to capital and owners. You can't keep doing that because K-shaped economies eventually die. They can't grow anymore. Because if you have very wealthy people that have most of the wealth, they're not going to spend, a high percentage of that wealth. Whereas the 50% or lower income groups spend most of their income. So we know there's all kinds of academic studies showing K-shaped economies will suffer lower growth. So I guess what I'm saying is if we're going to get GDP growth by keep taking money from labor, sacrificing labor for profits, eventually that's going to turn on its head because the economy won't continue to grow. And we, as you know, I'm sure you're well aware, this is the most K-shaped economy ever in the history of the U.S. And it's dramatic between the haves and the have-nots. And that will, if it continues, will actually depress economic growth. So that's another big factor, which is also, Marcus, why you mentioned that everybody buys the dips, right? Well, here's the problem with a K-shaped economy. The wealthy keep spending and keep, as long as the stock market exists, there's more, I guess, economic growth has been more tied to the wealth effect today because of the K-shaped economy than any time in our history. So if you really do get a down cycle that stays down, so if the stock market somehow went down 20, 25% and stayed there for a long time, or whatever, you get the virtuous cycle. You get the cycle where it would actually affect the economy way more than in past bear markets. In other words, a bear market is going to affect the economy more than it ever has. That's another major risk. If we go in a bear market and recession induced, it's going to be really hard to come out of it because it's going to affect spending more than it would in other recessions. So we have that to deal with. My whole point of bringing up this earnings growth growing faster than GDP is that if you're going to have these high valuations in the stock market, you're expecting higher earnings growth or more stable earnings growth. Well, how are you going to have higher earnings growth if GDP is going to be less than it was, for the last century without sacrificing labor? So we have that, big issue of how we're going to get growth in the future, right? With all those factors I just commented on.
So yeah, and that was a lot, and there was some salient points in there for sure. And obviously on the other side, we're looking at a new, today while we're recording, this will come out a little bit later, but this is presumably Fed Chair Powell's last meeting, right? So we have Warsh coming in. I think Tom tells us I'm down here in North Carolina, Wall Street is South Charlotte. Senator Tillis said he will allow the confirmation to go through, the nomination up through the board. And so I know Warsh is more concerned with, he thinks AI is going to help the Fed in different ways. He's concerned about AI obviously destroying the economy, but he thinks it's a way that something that we have to embrace and it will possibly help us outgrow this economy. That's just such a diatribe or a divergence in the way that the world's looked at right now, because half of the people and the people in charge of our fiscal policy, by the way, and monetary policy think that we're going to outgrow this that we're at right now with the deficit. That's why they're looking to lower interest rates and reduce the amount of debt that we have so it's easier to service this debt that we're paying. And then they're praising AI for the productivity booms that it's going to bring. But as you just mentioned, AI and this productivity gains, especially when you see it inside of the earnings, the gap in earnings and real GDP, like seems like a formula for chaos. How do you see force coming in and affecting this? The Fed could actually, this is something they could actually play a big part in, like whether we go into a recession or not.
Well, his number one goal is to reduce the Fed's balance sheet. So if he does that, that would probably cause long-term rates to go up. But he is going to definitely try, in my opinion, try to lower rates. I mean, he knows what Trump expects of him. So every new Fed chairman has been tested in the first 6 months. And what I mean by tested, the markets have taken the stock market or the bond market down within 6 months or a year of when a new Fed. So he's going to get tested likely. So I think the test could be.
And that is how you reconcile history with real-time execution. From the tech valuations of the 1999 to the K-shaped economic realities of 2026. David Snyder just gave us the ultimate blueprint to cut through the noise. As we saw at the end of that breakdown, Kevin Warsh stepping in to reduce the Fed's balance sheet, the old rules of the game are being completely rewritten. The market is going to test the system. If you haven't secured your own baseline operating system, your capital will leak into predatory loops. This was designed to be your permanent reference ledger. Bookmark it, rewatch it, and share it with at least one builder in your circle who needs to audit their math before the 12 to 18 month window closes David predicted. If you want to check out more of David's research, check out his website, Investment Advisor, over there at Journey One Advisors. If this session gave you clarity you need tonight, smash the like button. If you're one of the builders who helped us cross that 100 subscriber milestone, thanks and welcome to the community. For a full written breakdown to connect with over 1,300 professionals executing these strategies globally from Japan to Argentina, check out the description and subscribe to the Wall Street South Journal on LinkedIn. We appreciate every one of you who stayed locked in to the final second. And remember, this is just part 1 and 2. David's going to dive even deeper in part 2. Audit your roster, protect your capital, and remember the ledger never lies and it never sleeps. Main Street Heart meets Wall Street Smarts. We'll see you next time.